Hey guys, welcome back. You're still tuned into MF Corner here on CNBC TV18. We were just speaking about, where you can put in money into the MF space from our 2024 kind of perspective. But let's now talk about debt funds in particular. So there's a lot that, you can do within debt funds as well. There are many subcategories. So let me first welcome Kalpesh Ashar, Full Circle Financial Planners, to our studios. Kalpesh, thanks for coming in once more. Take us through how you would approach the entire debt space right now. We've all been talking about the fact that Fed has indicated that there will be 3 cuts in 2024. So markets are definitely going on with that possibility. But how would you look at this entire space now?
First of all, thanks for having me here, and a happy new year to all of us. So like what you rightly said, that for the past 2 years, we've been in a high interest rate regime, and of late now we've been hearing a lot of noises about the rates coming down and Fed giving those positive signals. But here there are 2 ways to look at it. That obviously people who are positive on this call of the rates being cut in 2024, they would, in the debt space, they would obviously look at the medium to long-term type of bonds because of the inverse, relationship between interest rates and bonds. That would be a benefit out there, and that would give that little bit of an alpha or a ticker in your debt-based portfolio. But also, let's be realistic to the fact that everything does not pan out in capital markets the way we would like it to happen. And obviously, not as much as a choice we have in the equity space. In the debt space, obviously the shorter end of the duration which is there, in which we've been living last 2 years, I think that also needs to be looked at a little bit more prudently and not go gung-ho about the interest rates. Because what if this does not happen? So we are back to square one. And in debt, probably I'm of always the capital feeling that debt is not for generating higher returns. Debt is more of a conservative type of a thing.
So the cushion.
Yeah, it's a cushion, and it should be seen that way because it's not in that zone where you can get into a higher returns zone type of a thing. That is left best to equity, what you should be doing. So coming back to this, I think if I was allocating my clients' money, I would put it still in 50-50. Okay. That's 50% in the long duration, just what if and what if not. So that long and short type of things both are taken care of. And the best part about debt funds is the liquidity part. So unless and until, a person really is not stuck about the money part and yet wants the liquidity, he has that cushion, he can take that money out whenever he wants. So I think the 50-50 approach for the 2024 should be a prudent one.
Oh, no, absolutely. And we are talking about fixed income being a place which is very tricky to understand as well for retail investors. Can you tell us some of the important points they can keep in mind, specifically when they're looking at the entire fixed income space? Yeah,
so there are 3-4 crucial points which a person should always be aware of, apart from the advisor. I think investor awareness is more necessary now in today's times. First and foremost is, like I said, that debt is for safety, and debt is like a cushion. So what is of prime importance here is the credit ratings of the bonds or the portfolio content which goes into the the debt schemes which we are having. And here, like obviously the credit ratings go as AAA being the most secure, but having a little bit of a lesser returns. I think that should be of prime importance, and AA, which is the other level of cushion. I think below that, then it gets into the risky zone. Obviously, the returns are also higher, but then it's always, buyer beware type of a thing. Second aspect here is the duration, because that plays a very important role. That we have a host of schemes today in debt funds which are catered to meet the investor's needs. So right from an overnight fund, which is a one-day type of a investment, right up to the gilts, which is a 10-year bonds or something, there's an entire duration range which you have. So according to your goals or your needs, I think you should be investing in that, because the maturity and the average returns are based on that. So if you have a requirement for say 1 to 3 months, there's a scheme for that. And don't go into any type of an credit risk type of a category. Like I said, there have been accidents. And if that accident happens and you're caught on the wrong end, I think your entire confidence is shaken up in the debt space. The third most part on which the entire platform of debt funds, I think, is based is nothing but the interest rate scenario. And everyone, at least the advisors, should be aware of that what interest rate regime are we living in right now. And the advice should be based on that probable account which is there. So I would always, base this on interest rate, credit rating, and duration. And most important, the quality of the portfolio also matters out here. It is very, very important.
Okay, got that. And I really like that you said that, the debt part of your portfolio is not the place to, play these aggressive games. Let that part be your cushion. Let that part be the safety net. But Kalpesh, you were mentioning some of the different investment tenures, the durations. Just take us through, everything that you can look at. What is the basket really like?
Yeah, so it's I think, a very textbook definition, but I think it needs to be brought to the fore. First and foremost, if you have a requirement from anything between, I would say, a 1 week requirement to 3 months. Today you have the liquid funds or the money market instruments which you can invest in, because the duration of that paper or that instruments which they invest is based on that. The second one is obviously the 3 months to 1 year range, in which you have the ultra short term funds or the low duration funds. Then if your requirement now for your debt requirements goes up to say 1 year to 3 years, then obviously you have the short-term bonds or the corporate bond funds, in which the average maturity is also suited to your investment profile which you want. And then you have the 3 to 5 year type of a duration, which is then best given to the medium-term paper. And finally, obviously the long-term ones, the gilts or the government securities which we invest in, is the place to go to. But let's understand here that in debt funds, it's a simple rule that higher the duration, higher the risk. And lower the duration, lesser the risk. So if you are going in for anything beyond 3 to 5 to 10 years in a debt fund, it's bound to be volatile. And if you're ready to ride out that volatility in debt funds, then so be it. And as a financial planner, I would always link it to financial goals. So I think that should be always taken into account.
And of course, as we said, right, the credit risk would change, the interest cycle would change over 10 years. So obviously that risk comes with long duration funds. Is this the reason why we see corporates and institutions being being the bigger investor in fixed income or debt funds or corporate bonds? Why is it not picking up with retail investors?
An interesting question, because corporates and the institutions always have this big money into the debt funds for ages now. And it's pretty obvious they need easy liquidity, and they don't have any other parking avenue. In the current account, there's no interest rate, the interest which is there. So obviously this is a +1 for them. But coming back to the retail investors, I think there are 2-3 points on it. One is still people equate mutual funds with equity. I think that's a big myth which needs to be cleared, and a lot of investor awareness yet to be brought in. Because, and like markets rise and there's a bullish phase, people always think that mutual funds is nothing but equity. So that investor education in the retail space is of prime importance. Second, I think whatever benefit earlier was there with debt funds with the taxation part, that's completely gone with the budget last year. And now it's on par with the FDs and everything. Now the gains are added to your tax slab. But here I would like to draw the attention here that still people do not understand, or they forget, that in debt funds, the taxation only kicks in when the redemption is done. So if you don't redeem even a tax, say, redeem a debt fund for, say, 2 years, 3 years or something, unlike in bank FD, where accrued interest is to be paid, you don't pay a single rupee of tax on your debt funds. So that benefit is still there. So I think it's more to do with, I think, making people aware of using debt funds and being a part of their portfolio.
Okay, got that. Very quickly, you want to run us through what the split should look like, equity debt for aggressive, moderate, and low risk?
Yeah, so that again would be a little bit of a textbook answer, but let's not forget that it will be dynamic and differs from person to person. So the aggressive mix probably for an individual would be 70% in equity and 30% in debt. A conservative is a no-brainer, it's a 50-50. That's 50% in debt and 50% in equity. And obviously the conservative type of investment would be 30% debt and 70% equity. But again, as I mentioned, that it can't be one size fits all.
Absolutely.
And it has to be, according to your risk profile. and according to your financial goals.
Okay, all right. We take that point. Thank you, Kalpesh, so much for joining us today. And with that, we'll take your leave on this edition of MF Corner. But stay tuned for Closing Bell to take you through the last hour of trade.